Oil prices appear to have moved higher with the start of the new year, yet may be ending this week in the red. Today we are going to have a look at the recent executive orders signed by Biden and the data of the US oil market. For a rounder view, we are going to conclude the report with a technical analysis of WTI's daily chart. On the 6th of January, President Biden signed an executive order which would withdraw certain areas of the United States outer continental shelf from oil or natural gas leasing. Essentially, President Biden has announced an offshore oil and gas drilling ban for certain areas surrounding the U.S. continental shelf. The outgoing president has used the 70-year-old Outer Continental Shelf Lands Act, which allows presidents to remove areas from mineral leasing and drilling. The act, however, does not allow presidents the legal authority to overturn prior bans, according to a 2019 court ruling. The announcement may have sparked concern about potential limitations for the incoming administration, which aims to increase energy production in the U.S., as seen by Trump's motto of "Drill, baby, drill." Moreover, the incoming president, for his part, has vowed to revoke the offshore oil gas drilling ban in vast areas on day one, which may be slightly optimistic as it may require congressional approval in order to be overturned. Thus, it is likely that Biden's order may not be undone immediately. Nonetheless, President Trump has also stated per Reuters that his administration would open up oil and gas development in the Arctic National Wildlife Refuge and take the matter to court if necessary. Overall, should President-elect Trump manage to quickly overturn President Biden's executive order, in addition to quickly granting oil drilling permits, it may imply that the U.S. oil production levels could increase in the near future. In turn, the implications of an increase in supply could weigh on oil prices as production levels could exceed the current oil demand in the U.S. Starting with the U.S. oil market, we note that over the holidays the Baker Hughes indicator showed that the number of active oil rigs in the U.S. was reduced by 1 to 482. The release signaled that the increase of active U.S. oil rigs was halted, which could also be perceived as an indication a slack in oil demand in the U.S. Nonetheless, this Tuesday, the API weekly crude oil inventories figure was released, showcasing a considerable drawdown of roughly 4 million barrels in U.S. oil inventories. The release implied a continued tightness of the U.S. oil market for a fourth week in a row, which may be perceived as a bullish for oil prices as aggregated oil demand surpassed production levels once again. However, the EIA on Wednesday also reported a drawdown of roughly 1 million barrels, which was lower than the expected drawdown of 1.8 million barrels. The lower than expected drawdown may imply that production levels may be meeting the current oil demand in the US, and thus should they exceed demand levels, they should weigh on oil prices. Nonetheless, generally speaking, the demand for oil in the US has once again surpassed oil production levels and thus may have aided oil prices during the week. However, should that narrative change in the coming week, it may have the opposite effect on oil prices. WTI appears to be generally moving in an upwards fashion. We opt for a bullish outlook for the commodities price, and supporting our case is the RSI indicator below our chart, which currently registers a figure above 60, implying a bullish market sentiment in addition to the upwards moving trend line, which was incepted on the 9th of December 2024. For our bullish outlook to continue, we would require the commodities price to remain above the 71.75 support level, in addition to a break above the 76.80 resistance line, with the next possible target for the bulls being the 81.60 resistance level. On the flip side, for a sideways bias, we would require the commodities price to remain confined between the 71.75 support level and the 76.80 resistance line. Lastly, for a sideways bias, we would require the commodities price to clearly break below the 71.75 support level, with the next possible target for the bears being the 66.20 support line. Those were the top financial stories for this hour. From all of us here at